Everyone dreams of retiring early, maybe at 40, sipping drinks on a beach somewhere. But what if I told you that retiring at 40 is a completely different ballgame than retiring at 65? It's not just about saving more money, it's about solving a much harder math problem. You see, traditional retirement planning is built for a 20-year horizon. But if you retire at 40, you're planning for 50, maybe even 60 years. This extra long timeline brings in some serious risks that most people never even think about. The biggest one, the one that wrecks more early retirement dreams than anything else, is something called sequence of returns risk. Let's break it down. Imagine two people, Alice and Bob. Both are smart savers and they both retire with a cool $1 million. They each plan to withdraw $40,000 a year to live on. Now, Alice retires and luck is on her side. The stock market goes on a bull run for her first 3 years. Her $1 million portfolio grows, creating a nice, comfy buffer. So even if the market takes a dive later on, she's well protected. Her plan is on solid ground. Then there's Bob. Bob retires, and boom, the market crashes 20% in his very first year. It's a brutal truth. The order in which you get your investment returns matters way more than your average return over the long run, especially at the beginning of retirement. A bad start can be fatal to your plan. So, how do early retirees fight this? How do you protect yourself from a market crash right after you pop the champagne? The strategy is surprisingly simple. You build what's called a bond tent, or a cash buffer. Here's how it works. Before you retire, you set aside 2 to 3 years of your living expenses in something super safe, like cash or short-term bonds. This is your emergency fund for a market downturn. If the market crashes in your first year of retirement, you don't touch your stocks. You don't sell anything at a loss. Instead, you live off your cash buffer. You just wait it out until the market recovers. This simple move insulates your main investment portfolio from that devastating sequence risk. It's your financial storm shelter. But that's not the only storm you need to prepare for. The second major risk for early retirees, especially in the United States, is the healthcare gap. This is a big one. Medicare doesn't start until you're 65. So if you retire at 40, you've got a 25-year gap where you are completely on your own for health insurance. If you've always had a job with benefits, you might not realize what a massive subsidy corporate health insurance really is. When you leave that job, the sticker shock is real. A decent family health plan could easily cost you $20,000 to $25,000 a year. That's a huge expense. You have to factor this cost into your retirement number. If you forget to account for a $25,000 annual healthcare bill, your entire plan could fall apart. Your 4% withdrawal could be completely eaten up by insurance premiums, leaving you with nothing left for, food and a place to live. That's a catastrophic oversight. So, when you really look at it, early retirement isn't just about accumulating a giant pile of money. It's more about becoming an expert in risk management. You're not just planning for the good times. You're actively managing what the pros call tail risk, those low probability, high impact events that have the power to completely derail your financial independence. It's about building a robust plan that can withstand the unexpected storms. Thinking about these risks isn't meant to discourage you, but to empower you. By understanding them, you can build a smarter, stronger plan that truly lasts a lifetime. Thanks for watching, and if you found this helpful, be sure to like and subscribe for more insights on financial freedom.